Breaking news. China is pulling a staggering $170 billion out of the United States, and the world is watching. What does this massive move mean for America's economy? Are our factories at risk? And how will this reshape global power dynamics? Stay tuned as we dive deep into this unprecedented shift that could change everything you thought you knew about international markets. Let's get into it. It started subtly: missed meetings, unreturned calls, and investment deals quietly vanishing. But soon, the magnitude of China's actions became unmistakable. The Chinese government issued directives to its domestic airlines to halt accepting new Boeing aircraft deliveries and suspended purchases of US-made aircraft parts. The Bank of China officially canceled all its airplane orders from Boeing, one of America's most significant corporations. These aren't isolated incidents. They are part of a broader, calculated move to withdraw from the American economy. This withdrawal extends beyond aviation. China is divesting from US pipelines, tech ventures, real estate projects, and manufacturing collaborations. The message is clear. China is no longer betting on the American economy as it once did. This withdrawal isn't driven by politics alone, but by strategic economic reallocation, signaling a shift in global power.
Is a broader cachet of companies being caught up in US President Donald Trump's trade war, in which at least Chinese goods, they're being imposed a tariff of up to 145%. Now, what we know this time is that the Chinese government has asked its carriers to stop taking delivery of Boeing aircraft in the meantime, and this extends to aircraft-related equipment and parts from US companies. Now, this order...
From investment peaks to near-zero engagement, the scale of China's disengagement is staggering. In 2016, Chinese investment into the US peaked at over $45 billion. By 2018, that number had plummeted to just $2 billion. Today, Chinese capital in the US is practically non-existent. The once vibrant flow of investment, fueling tech corridors in California, manufacturing hubs in Ohio, and real estate booms, has evaporated. Factories that once received green lights are now abandoned. Venture capital funds are withdrawing. Chinese-backed projects are disappearing from the American landscape. This isn't merely a macroeconomic adjustment, it's a strategic reallocation of power. Chinese capital is not leaving the global stage, but shifting elsewhere, across borders to Mexico, Canada, Southeast Asia, and Eastern Europe. The goal? Diversification and risk mitigation amid mounting geopolitical tensions and trade restrictions. Nearshoring and rebalancing power. Mexico stands out as one of the biggest beneficiaries of this capital exodus. Over the past 2 years, Mexico has attracted more than $200 billion in new industrial investments, automotive plants, semiconductor assembly lines, logistics hubs, all sprouting across regions like Nuevo León, Coahuila, and beyond. Many of these facilities are Chinese-owned, purpose-built to serve the American consumer while bypassing tariffs and trade barriers. Mexican President Claudia Sheinbaum has embraced this trend, welcoming both Chinese and American manufacturers. The government is actively expanding infrastructure, energy, water, rail to support this industrial surge. Multinational corporations follow the capital, eager to capitalize on nearshore advantages. For instance, BYD, the Chinese electric vehicle giant, was preparing a $600 million plant in northern Mexico. However, in April, the project was frozen, a direct consequence of the White House's tariffs and trade restrictions, highlighting how geopolitics is shaping economic realities. Trade wars and supply chain realignment.
U.S. President Donald Trump has signed an order to levy 25% tariffs on imports from Canada, Mexico, and Mexico. Tariffs of 10% are to be imposed on China. Duty on Canadian oil will be slightly lower at 10%. Trump cited what he said was Canada and Mexico's failure to halt illegal immigration and drug trafficking into the United States. Tariffs will take effect on Tuesday and will remain until Trump determines sufficient measures have been taken by Mexico and Canada. Both Canada and Mexico have said that they will impose retaliatory tariffs on American goods.
The U.S. response to China's retreat has been swift. Former President Donald Trump imposed a 25% tariff on all goods from Mexico and Canada, aiming to protect domestic industries. In response, supply chains faced upheaval. Factories paused construction, contracts were suspended, and shipments were scrutinized. For example, BYD's Mexican plant was shelved after export licenses were blocked, and projects employing thousands vanished within days. This is more than economic friction. It's a battlefield. The disruption extends beyond manufacturing. The aerospace industry, exemplified by Boeing, has felt the sting acutely. Earlier this year, Chinese airlines halted all new Boeing deliveries, rejecting fully built jets, some returning to Seattle or sitting idle. The damage to investor confidence and the potential loss of thousands of jobs underscore how intertwined and fragile this supply chain has become. The broader geopolitical landscape. Meanwhile, Canada is pursuing a different strategy. While Chinese firms are blocked from many of Canada's sensitive industries, particularly critical mineral mining, Ottawa is actively developing strategic mineral projects. Over $17 billion is invested in lithium, cobalt, nickel, and rare earth elements, crucial ingredients for electric vehicles, semiconductors, and advanced weapons systems. These materials are vital for the next era of technological and military dominance.
A group of 7 leaders are gathering in Alberta, Canada today, where much of the focus will be on trade.
From Canada, but it's up to them. They're going to have to pay a lot of tariffs and things. They're going to have to pay a lot of money for the dough.
I should remind people that those are tariffs that are paid by American businesses, American consumers.
Canadian leadership will be defined not just by the strength of our values, but also by the value of our strength.
What happens when a global summit meant for cooperation turns into a high-stakes trade battle? It's not just diplomacy at risk. It's the future of the...
However, 3 years ago, Canada ordered Chinese firms to divest from key mining projects. Now, the U.S. closely monitors these developments, seeking to secure critical minerals for its own defense and clean energy initiatives. Federal procurement rules now prioritize sourcing from allied countries, elevating regions like Quebec and British Columbia as vital strategic assets. But the shift isn't just regional. Chinese capital is moving beyond North America, expanding into Southeast Asia, Latin America, and Eastern Europe. Countries like Vietnam, Indonesia, Malaysia, Peru, Chile, Serbia, and Hungary are witnessing a surge in manufacturing zones far from American shores. This de-risking strategy acts as insurance against tariffs, sanctions, and the looming threat of a new Cold War. It's a geopolitical insurance policy, building resilient supply chains outside U.S. influence. America's response. Recognizing these shifts, American companies are scrambling to rebuild domestic manufacturing. Intel is constructing semiconductor fabs in Arizona. Tesla is expanding lithium refining capacity in Texas. And Ford is investing billions into reshoring battery production. Yet, these projects take years to mature, and the interim costs are mounting. The impact is already palpable. Tariffs and sanctions are raising costs for automakers like General Motors and Ford, with estimates suggesting tariffs could cost GM up to $5 billion this year alone. Manufacturing delays, parts shortages, and delayed electric vehicle launches are becoming commonplace. Boeing, once a symbol of American aerospace prowess, now finds itself at the center of supply chain disruptions. Chinese airlines halting Boeing aircraft deliveries and existing backlogs denting investor confidence. The ripple effects of these geopolitical shifts are not confined to corporate balance sheets. American households are feeling the pinch. Tariffs are driving up prices for cars, electronics, and building materials. Experts estimate that the average household could pay over $1,000 more this year due to tariffs and supply chain disruptions. Moreover, Chinese companies are beginning to delist from U.S. stock exchanges, while tech giants withdraw listings from NASDAQ, returning to Shanghai. Universities that once hosted Chinese scholars are witnessing plummeting applications, signaling a decline in trust and collaboration. At the legislative level, lawmakers are advocating for stronger export controls, bans on outbound Chinese investments, and the establishment of a digital iron curtain aimed at safeguarding technology, data, and scientific innovation from potential Chinese influence. A new global power balance emerges. China's withdrawal of $170 billion from the US is more than an economic maneuver. It's a signal of a changing world order. The era of global trust built over the last 4 decades is waning, replaced by strategic decoupling, nearshoring, and regional alliances. China is not retreating out of spite, but preparing for a future where independence and resilience are paramount. America's scramble to replace factories, secure critical materials, and rebuild its technological edge is a race against time. The coming years will determine whether the US can maintain its global influence or whether this shift marks the beginning of a new era of multipolar power, one where economic and geopolitical independence take center stage. As the world watches, one thing is clear: the global economic landscape is undergoing a profound transformation, and the stakes couldn't be higher.